My current dollar view, and it's been my view for a few years, is that in this decline in the dollar from 115, back in 22, I have been saying we could get down to 82. So I think between now and sometime in the first half of 2026, we'll see the dollar down to 82, probably more likely first quarter next year. But so that's a big drop. The next step, because we've been consolidating around the mid 90s here for a little while, I think it's pretty soon we're going to see it roll out of that. And the next step is 90-ish, and then we'll have another down to 82, I think, probably next year. And then later on in the bust, I think you'll see a flight to safety, as we always do, into the dollar. So I think you could go all the way from 82 back up to 120. And if we're talking about an 80% decline in the stock market here, imagine what the story is around the world. And if Japan blows up, if China blows up, if Canada has real problems, if Europe has real problems, there's not going to be very many places where foreign investors can go. They'll be coming into our treasury market in a big way. And that's the funny thing, is the narrative out there has been all about what do we do to replace the foreign investor? I go, that's not my worry at all. We don't need stable coins. We don't need anything else. At least in the next year to 18 months, there's going to be plenty of demand from both the Fed and foreign investors, along with domestic investors, institutions. There won't be enough treasuries to satisfy all the demand. So that's why you get a big drop in rates. But anyway, I think the dollar can have one last run to 120, and then post bust, I think we begin a long decline. And part of the long decline is, yes, we're in the end of a 43-year secular bull market in stocks. I think we're also in the last decade of big macro cycle, and I define a super cycle as the big cycle between two depressions, the 1930s being the last depression. I think probably mid 2030s and beyond being the next depression. So we're in the last decade of a super cycle, and everything goes crazy. That's why we've seen what we've seen in really the last 15 or 20 years, and it just gets more extreme. What it's going to take to pull us out of that bust, in my opinion, is probably going to be something on the order of 20 trillion in new QE. That's just the Fed, proportionally similar around the central banks around the world. And what I'm describing here is, if you go back and start post-depression, so 1940s, early 40s, what we've seen is, we have these economic cycles. We go boom bust, and each successive cycle, pretty much, they've had to do more to tighten down because inflation was breaking out, and then they went too far, and then it took more to pull us out. And somebody said it's kind of a buggy whip type thing I'm describing. So that each successive cycle got more violent or more volatile. And we're now in the last decade where we get to the real extremes of that volatility. We had 2008-9, and you thought that was the big one, right? I think this one's going to be bigger than that. And the problem is, with leads and lags, they don't know when to stop. They just know they got to keep going until they stabilize things, right? If we're getting a banking crisis across the world, with bank failures dominoing across the world, they can't sit back and say, because Powell has been on record as saying, we're not doing that again. We're not going back to blowing up QE and, bailing out the stock market. So part of the reason we're going to get the bust is because the reaction is exactly that. He's going to be slow to respond. He's going to say, well, we don't want to do that again. We know what happened last time. We don't want to go to 0% interest rates. We don't want to, no interest rate policy. Money eventually means inflation. We don't want to do that. That's fine to say until you're staring in the face of this abyss. And then it's deer in the headlights time, and they're just pumping money like crazy because there's really no other policy. You can't go to Congress and say, fix this. This stuff's happening minute to minute, day to day, right? We saw that in 2008. You can't go to Congress and say, we're not going to print money, you have to solve it, especially in this time. So you're going to see so much money. They'll start slow, meaning slow might be $1 trillion, and wait a couple weeks or a few weeks, and it's still free falling. Then they go to 3 or 4 or 5 trillion, and it's still falling. It'll take them time to get to a right size policy, because that's where I get a lot of pushback, because people go, that'll never happen. The Fed would never let that happen. Not on purpose, but if they're reluctant, and it takes some time to recognize that they can't be reluctant, it's in that time that it takes several months for them to get to right size policy that you can just keep going down, going south. So that's the backdrop for the next cycle, is if they print, and again, it's seat of the pants, I'm throwing out a number. I don't know whether it's going to be, 18 trillion or 25 trillion or 15, but I think it's somewhere around 20 trillion just from the Fed. If they do that, which is, I have to remind people, in 2008, going into the crisis, the Fed's balance sheet was 875 billion in October of 2008. We went up to 9 trillion during the pandemic. We're now down towards 6 trillion, 6.5 trillion. If we go from 6.5 to say 30 trillion, it's beyond anything we've ever had in this world. And again, add up all the central banks, maybe it's 50 trillion. I don't know what it is, but it's well beyond anything we've ever had before. And because of the lag, they don't know what they're creating. And what they're going to create is a hyperinflationary cycle far worse than the early 80s. I was in institutional investing back in the early 80s. We went to 20% inflation. I think this time we probably peak around 25% in this country. So we go from deflation to, let's say, by early 2030s, we could be looking at 25% inflation. What does that do to rates? That takes rates from a 0% 10-year to probably a 20% 10-year, or certainly
Easy.
High teens. How do you solve that equation when you've got the kind of debt imbalances we have? We can't finance it at 5%. How do we finance it at 20? And probably we won't know how to finance it at 10. And the thing that people don't understand is that once you start seeing inflation, and again, it's going to take a little while. If you go from -3 or 4, the first year out, you might be positive 2, 3, 4. Second year out, you might be high single digits. Third year out, you might be double digits. Fourth year out, you're probably approaching 15. And fifth or sixth year out, you're approaching 20 and upwards. So it's not that it all happens in 6 months or a year, but the reason we've had a 43-year secular bull market is because from the early 80s till now, we've had disinflation with, a couple bumps up, but we go from disinflation to deflation up to inflation and hyperinflation. That's a whole different environment that most people in the investment world have never experienced. I did, because I was back there, and the people who've been around for 50 years have. But for a lot of people, they've only invested in disinflation. So we're into, starting next year, some investment environments that they've never seen. And it will be a very different leadership. By the way, if you're printing 20 trillion, you will have, I said before, I thought the peaks of this secular bull market would stand for decades. That doesn't mean you won't have opportunities. The 20 trillion will create a cyclical bull market. If you're down 80% from, let's say, 9,000, down 80% takes you 1,800 on the S&P. You could quadruple from 1,800 and still fall far short of that 9,000 peak that we had. So it's the beginning of a secular bear market where you have lower peaks and lower troughs. But if you come out and triple or quadruple out of the bottom, obviously there's some great investment opportunities in that. Just understand that it runs out of gas pretty quickly when it's competing with double-digit interest rates. So it might be a cyclical bull market for a couple of years, but the leadership's going to start dropping off because growth stocks won't be able to stay up with interest rates moving up so fast. Consumer stocks, consumers not going to be in anywhere near the shape to, even consumer staples and things are going to struggle because they're steady growers. And so it ends up being the commodity sector, the industrial sector, because of all the reshoring we're going to see, select technology. I'm not saying there won't be some real growth areas that can outpace inflation, but, AI or whatever, there'll be some places. But the leadership that we've had the last 15 years, tech and more recently healthcare, those areas are not going to be the leadership next cycle. It's going to be, like I said, it's going to be commodities. I think oil can go to $500 a barrel. I'm calling for $30 a barrel oil in 2026 in the bust, and then to go from there over the course of the next 6 or 7 years to $500 a barrel. Natural gas might go to 50, who knows? When you print to those extents, it leads to demand. It pushes demand up. But what isn't pushed up, because it takes a decade to build a new oil field, right? Supply can't match the demand. Demand goes through the roof because you artificially pushed up demand with all this money. And I can get there from where's that demand coming from? Well, obviously we look and we see all the energy demand we're going to have from AI. We see the demand from all the industrial expansion we're going to have, et cetera. So you're going to have demand ramped up and supply, which we've been ratcheting down for decades, particularly with the green energy thing. But you're going to be stuck with a a finite supply, and obviously you'll begin a big new exploration period in energy, so that there's going to be great opportunities in energy exploration and development, but it won't come online fast enough to meet that demand. So the only thing it can give in that period is price. So we're going to have, you can see the inflation from a monetarist money standpoint, but you can also see the inflation from the supply demand standpoint in these commodities. Copper could go to 20, from 460 now, could go down to one, a buck in the bust, but then go to 20 or higher in the expansion. So you're going to see all this stuff get ramped up. Very different environment than what we've had for the last 40 years. And as I say, anybody that was smart enough to listen to their financial advisors who said it's time in the market, not timing in the market, and put their money in index funds back in 1985 and just kept adding to that, they've outperformed most active managers for the last 30 or 40 years. But if you think about the next cycle, with rates moving up as rapidly as I'm talking, you're going to put real pressure on PE multiples. And the things that are the heaviest weighted in the S&P at the end of this cycle will be the worst things to own next cycle in many cases. So it takes a long time for that to get rejiggered, as people sell the losers and buy the new winners. That happens over many years, not over months. So you're going to have the S&P and, the NASDAQ and all the other indexes that have done so well for the last 40 years are going to be the laggards relative to if you just put your money in energy stocks or precious metals or, copper producers, et cetera. So both commodities and commodity stocks will be the leaders. Lots of industrials, Caterpillar, for example, is going to have plenty of demand for all those new mines that have to be, et cetera. So those are going to be the winners, steel, all that stuff. And then the laggards are going to be all those steady growers dependent on the consumer, dependent on new technology and things like that. Now, semiconductors is a kind of an interesting one because no doubt AI is here to stay, and no doubt there's going to be more and more demand. So it is a tech commodity sector. So they may do pretty well, but probably not to the extent we've seen the last 5 years.